time for the healing process to getting the prices. So there may be still a tailwind. We'll find out.
We have a special guest today on the Everyday Trader. Just kidding. I'm going to end this right. I'm going to mute it. Chair Powell is right in the middle of his update from the FOMC. But coming to you, well, live for us, you're watching the recording. It's Eric Hale with Trader Oasis on another episode of the Everyday Trader, and joined by me is Mariners fan. Actually, we have a good client from the Mariners, don't we?
We do. He's
Hall of Famer.
Hall of Famer.
Yeah.
I'm sure
He's doing okay. Hey, Edgar, miss you, man.
I'm sure he's doing good. The Mariners have a good young team, and I'm still pulling for him to figure it out this year. They need to add just a couple more pieces, but unfortunately, the Dodgers took that piece from everybody. I say unfortunately for the Mariners, fortunately for the Dodgers. I'm representing both today. You know, big news: 8 days until pitchers and catchers report.
Pitchers and catchers. Yeah. So welcome to the Everyday Baseball Podcast. And you got your Los Angeles shirt. Cubs are looking like they're going to be pretty good too. But
yeah,
let's not talk about that. I can't wait for spring. Spring's hope's eternal. We got a special treat for you. You folks loved our last episode, my favorite trade that I shared, and it's so far our fastest growing video. It's not the number one yet, but the way it's growing, we think it will be. And our total number of subscribers hit a threshold of 1,000. Thank you very much. Personally appreciate all of you out there. We're doing this for you and appreciate the feedback to help us grow, and appreciate you sharing and liking and subscribing. So please keep up with that. But we do have a special treat today because we did Eric's favorite trade last week, and today we're going to do Greg's favorite trade.
Hey, it is a good trade, and I may do it on my favorite company too.
Okay. So this is maybe not specifically a trade idea, but a trade style that we teach at Options Animal, and that Greg, probably nobody in the world understands how to trade better than him. And if time allows, we'll maybe pop up an example and show you in real time. But before we do that, we wanted to talk about a few other things. So the Chair Powell is speaking right now, and the announcement that's came up, initially the reaction in the market was bad. I can pull up a chart here. Oh, geez, there we go.
Oh, we're actually rolling back over again. We had a knee-jerk bounce to the upside, but now we're back down 40.
Oh, we are?
Yeah.
When Tim Rose started talking. So here's when at 2 p.m., the press release came out, and actually probably can share Tim Rose's tweet. So there were substantial changes. Usually the Fed statements have very subtle 1 or 2 words, and we spend a lot of time. There's a lot of red here, a lot of changes. And so what was sort of expected was that there would be a less hawkish stance talking about the need to tighten, which is definitely gone. The bias to tighten is gone, but they did it in a way that doesn't say a cut is coming. So the committee does not expect it will be appropriate to cut until it has gained greater confidence that inflation is moving sustainably to 2%. And right now, the press conference is going on with the Federal Reserve, and they're asking 52 different ways. When are you going to get to 2%? And will you cut early? So we don't really know what the answer is going to be. The CME FedWatch tool, which we can update, is currently showing the current rate is 525, 550. So let me do the compare here. So we are getting a bump up. This has actually moved up a little bit today as we're speaking here. So the odds right now are that we could be getting a rate hike. But before I want to go to this, did you see my tweet on this? The Fed funds rate, this data right here, how absolutely abysmal it is.
It's very abysmal. And, so
let's talk about this data here and how right it is. This chart, check out this chart. This is from research from Deutsche Bank that came out yesterday, that they talked about what happens. It's a really good report because it talks about what happens after the Fed cuts rates. And I'll share what that is right now because I think it's important for everybody to understand. if we are not in a recession, it is going to be really, really good for the market. If we are in a recession, it will be bad. Now, that's not easy for us to know because we don't usually know that we're in a recession until it's backdated. But we will be doing our best. This is why we stay on top of this economic information to share it with you, to try and give you some upsides, because there are leading indicators that can help us understand if there's a recession or not. And we look at those things all the time. But look at these dotted lines are previous forecasts of where the Fed funds is going to go. And the yellow line is where we are today. Greg, do you have any confidence in the market's ability to forecast Fed fund rates based on this data?
Zero confidence. I mean, the market's been forecasting the rally we had from October through December built in upwards of 7 to 8 rate cuts this year. Fed Chair Powell just said again, he and most of the board want to cut rates this year, maybe up to 3 times.
That was the general consensus as of December last year,
Yeah.
right? That was what the SEP, this Summary of Economic Projections in December, was that we forecast maybe 3 rate cuts next year. He just reiterated. Doesn't mean it's going to happen.
But the CME group, which again is the market pricing in the Fed fund futures, has got 6 to 7 rate cuts priced in, and it's just wrong.
1, 2, 3, 4, 5, 6, 7 rate cuts priced in. And as I've said before, I will eat a shoe if we cut rates in March. We are not going to cut rates. Well, today we just know we're not going to cut rates today. And if we do in March, I'll eat a shoe. I don't think there's any way that's going to happen. We don't have enough data between now and then. We do have a lot of data coming in. So big, important payroll report on this Friday. So we got the non-farm payrolls and the unemployment. And the thing to keep an eye out for is the SOM rule. You're probably seeing that out there. Claudia SOM is an economist, former with the Fed, and she came up with this rule of how the inflation rate or unemployment rate changes. She's tweaked that guidance a little bit. So we'll talk more about that later. But we might, get an indication that we're heading towards a recession. And if we see a spike in unemployment, then I might be eating a shoe. But right now, I don't think I'll be eating a shoe. So this Fed fund rate issue here, we can talk a lot about it's going to be what it's going to be and how many cuts and when. It's going to be data dependent. And I didn't ask you about this before the show, but where are you going to be in 2 weeks?
In 2 weeks, Arizona at spring training. I don't know.
No.
Where am I supposed to be in 2 weeks?
Did you buy your plane tickets yet to go to the Bahamas?
You're making me admit it live. I actually just had to cancel.
Oh, okay.
I'm not
I understand. I know you got family stuff going on.
Yeah.
Well, I will be hanging out with our favorite Fed governor, who is always a ball of fun. And this is not an iota exaggeration, because I know you don't feel good about this, because Waller is hilarious.
He is fun. He is
fun.
And so you will have to give him my best when I do not get to see him. I was hoping to be able to hang out with him.
Yeah, it'll be fun. We're gonna be in the Bahamas at an economic conference, and I'll be hanging out we're at the Margaritaville Resort. So I'll be drinking the virgin margaritas, sitting by the poolside or on the ocean, hanging out with our friend Chris Waller, as well as some other fairly significant people, getting us some insight. And I can promise you, I will have long conversations with him about this. And as he said before, you remember one time I said, "Hey, Chris, Chatham House rules," and he's F Chatham House rules. I'll tell you what I effing think. So I will share that with you folks. I listen to pundits talk about what they think the Fed is going to do, and most of these people have never even spoken to a Fed person, and you're reading what other people are reading. I'm very fortunate to be associated with some well-respected people and get invited to some of these events. And I try to share it with our community, and they want me to share it. Like Waller wants the word out there. He doesn't like it. It's better than the media taking and putting its own spin on it. So we'll try to share what we can share and insight, and hopefully give you folks an edge.
You know, it's that they're in a tough spot, and that they've done an amazingly competent job up to this point of managing rates, managing expectation. And yeah, we've had our blips in the banking system that they've caused a couple of tremors, a couple failures in some banks. That's been about a year ago that happened. But they still have to manage the idea that if they do start to reduce rates too fast, they're going to resurge inflation.
Yeah. And
But if they,
that would be awful.
but if they reduce them too slow, and I think why most of the committee wants to start raising rates is they do recognize that their policy is restrictive right now. And if they don't take their foot off the brake, they're going to send us into recession, which puts you in that other category that you mentioned. If the Fed has to start cutting rates when we're in a recession, that's bad for the markets. And
Arguably,
so
we're at all-time highs in the market, so a little bad is probably okay.
it might be actually.
Like whatever. I mean, I don't know. People are like really upset about what are rate cuts. It's like GDP is phenomenal. Employment's great. Inflation's coming down. So what do you want? I mean, I understand, but we
They
talk
just
too much about rate cuts.
They just want Nvidia to keep going up. That's what they want.
Nvidia. For sure. I want to I was gonna share one other tweet that's sort of unrelated, but something that I read. I read a report yesterday from Goldman Sachs, and I shared this yesterday, just a section of it. So Goldman Sachs has their 2024 forecast out, which is very heavy weighted on US preeminence, lots of US stock. And they say, in response to the strategic question, our long-standing view of U.S. preeminence is intact based on the country's unparalleled combination of the following factors: largest economy in the world, currently at 20%, 26% of global GDP, highest GDP per capita, except for a handful of sparsely populated countries that are rich in natural resources and tax havens. Those are less than 1% of the GDP. So of major countries, we are by far number one. The largest, broadest, and most liquid financial markets that support economic activity in public and private sectors. There's no question that we are where people want to come, businesses want to come, and companies want to have their equities listed. By and large, we're number one there. Most favorable demographics relative to all major countries. You probably have heard some of the demographics. Not sure if you read Peter Zion's stuff. Kind of scary, except India. India has really good demographics. Highest labor productivity, strong culture promoting, rewarding innovation and risk-taking, persistent and diverse corporate earnings growth, extensive natural resources, safe haven status, and resilience. What do you say, Greg?
I'm going to quote Warren Buffett. For 248 years, it has been a bad idea to bet against America.
Amen.
God
bless America.
I'm going to say the same thing.
God bless America.
And does that mean our markets always go up? No. And obviously, from a trading standpoint, there's money to be made when markets go down. You need to understand how to hedge risk when we're at all-time highs and there's a potential for markets to go down. But in the long term, we have a system here in the United States that drives productivity. It drives creativity, things like artificial intelligence that we know are the next factors of growth in this booming economy are being developed right here in the United States. So absolutely.
Yeah, it's not without risk factors that are out there. So, but they debunk a whole bunch of myths. This old de-dollarization that was out there, we were talking, I mean, that's been going on since the 70s. Saudi Arabia in 1974 said they're going to go off the US dollar. They do a really good job debunking a lot of myths that are out there. And there's a lot of things that are working in our favor. This de-globalization, we haven't really been talking to people about what's happening overseas, but this Red Sea thing is really dramatic in combination with the Panama Canal having drought conditions. It's really could potentially affect shipping. Everything that happened during COVID was pushing friendshoring or reshoring. And that lines up right with President Biden's, and I'm probably making somebody upset here. President Biden has done a few things that are okay. And one of which is to try and bring manufacturing back home. And we've seen a tremendous influx through IRA and the CHIPS Act of dollars being spent here in the US to try and minimize our impact on foreign countries. And this is a good thing. It could be a good thing, but sometimes international is a bad thing, but certainly doesn't hurt the United States from this standpoint.
By the way,
Anyways.
we're just talking, and we must have missed the comment because the S&P is now down 65. And the quote that I'm reading on Twitter is that Jerome Powell said he does not think it's likely that the Fed will cut rates at the next meeting in March.
Woohoo! I don't have to eat a shoe.
So
that's the quote. So here it is. The market's updating as we're going through here. Has it updated yet in the Fed funds rate futures yet? I guess this lags a little bit, I think.
this will lag a little, yeah.
Yeah, it's not loading actually. Yeah, so this will lag a little bit. Well, we'll see a change there. Yeah, for sure.
Well,
Fed futures, FOMC, Goldman Sachs. We've got a big week of earnings this week, so a couple of biggies. We've got a lot under that already happened. We had Microsoft and Google. I'm trading Microsoft and in it bullishly, so I'm a little happy. It wasn't terribly bullish, but Google's down a little bit. But what are your thoughts on? Do you have any thoughts on Tesla or Google or Apple?
I think Apple's earnings are not going to be fantastic. I know that what I have read out of China is there's still a potential big negative impact that, particularly in iPhone growth, that is going to impact Apple's earnings. So, well, I would not be surprised to see Apple actually miss their guidance in China, which is where their biggest growth factor is. So I'm leaning bearish in the short term, probably on Apple. Now, in the long term, I still love the company. I still think their cash flow is fantastic at their position in the market, their brand loyalty, all these things, their powerhouse balance sheet. But this is a stock that's mostly gone sideways. It's been really choppy, but it's mostly gone sideways for like 6 months now, as the market's rallied back to all-time highs. So,
just let me share one thing with you. Does this look like the future?
No, I don't know. I have a hard time still with virtual reality. Although I can tell you,
I love Apple. I own everything Apple. I would buy Apple underwear. I own Apple. I have an Apple pen. I have Apple clothes.
Are you going to get one of those? I don't know if I'll buy.
Are you going to buy it for me? If you buy it for me, I'll get one.
All right.
I don't know. Maybe we should buy one and raffle it off at. Are we going to do a summit in Vegas?
Summit. We are doing a summit in Vegas.
Ooh, anybody who wants to come, can anybody come? Can we invite all our friends here?
Sure.
Okay.
Come
in
to
Vegas around tax day, somewhere in there.
Yeah. We don't have an exact date yet. It's middle of April.
Listen,
we're waiting for our finalized contract from the venue where we're going to be holding it. So that's why I can't give you
$3,000. You pay for your travel expenses, $3,000 to get in the door. It's worth every penny.
Absolutely.
And if you ask, we'll give it to you for free. But it is definitely worth $3,000. Literally for me, my first summit, game changing, like life changing. And I've had people, we don't charge money for these summits. Our members get in them for free. And I've had people tell me that we're idiots, that we should be charging $2,000 or $3,000 because that's what people do, these webinar or these weekend events where they go to learn to trade. It is worth every penny. So if you're interested, let's see if we can find a way to get you there. But more details on that to come.
It is one of the benefits of the community that we've built at Options Animal for sure, is going to these live events and meeting one another. And, we have a very strong, robust online community, and that's where the bulk of our education happens. It's where the bulk of our trading happens, right? We don't come to these events necessarily to learn anything groundbreaking and new, but that doesn't mean there isn't an enormous amount of learning that happens at these live events. So yeah, we're excited for it. I have to be honest in that my presentation that I do at these events has not changed in 15 years. I mean, it has.
I've noticed that.
It's adapted from here. I try to change the slides and mix it up a little bit, but the reason
Why hasn't it changed, Greg?
Is because the trade itself that I teach, that's the foundation really of all of our methodology of how we teach people how to trade at Options Animal, is this trade, this collar trade, that is my favorite trade that we've been talking about. And in fact, your favorite trade that we talked about a couple weeks ago when we did the Costanza trade really is an introduction into the collar trade. I mean, it's a way of...
Oh, yeah. You really can't do that Costanza trade unless you understand what a collar trade is. And a collar trade is very simple to understand, but to me, I tell people it's like Texas Hold'em poker. Very simple game. Takes a minute to learn, a lifetime to master. And the same thing with a collar trade. It is a very simple trade. There's only 3 components. It's got stock, it's got a short call, got a long put. But you can structure this thing to do literally anything. Bullish, bearish, stagnant. You could have it Vega positive, Vega negative, theta positive, theta negative. It can leverage any trend. And that's why it's so versatile. It is completely possible to be in a risk-free trade where you own shares and can't lose money. You don't usually enter into one of those. That there's no free lunch out there. But if you are savvy and you manage, and it lets you sleep at night because you have very limited risk. It doesn't require capital, but very little risk. So let's talk about one right now, Greg. So why first of all, when do you like to do these trades? Like around earnings or any time or certain signals? What are your thoughts?
2 times that I like to do these types of trades. One is in front of earnings. Now, let me take another step back though and say that in my trading plan, my big term trading plan, I'm actually always in a form of a collar trade. To me, long equity, long stock is the collar trade. It's just missing the 2 protective components because I don't have to have them on all at the same time. But the actual trade itself, the way you defined it, is if I'm in a long stock position, a long put position, and a short call position with varying expirations, that is my collar. And it allows me to protect my downside. Regardless of where the stock goes, I can have a hedge, and it allows me still some upside if the stock gaps up. And so for me, the ideal time to have this trade on is when there's expected volatility. There's expected movement in the stock. That could be a product announcement. Apple's famous for those of having product releases. Tesla's famous for those of having, meetings where they're releasing new products. It could be FDA approvals on drugs. If you have those dates out there on, if you're trading a biotech type company and there's a date that the FDA is going to say yes or no to a drug, this is a type of position or type of trade that you can do around it. The most common one that every stock goes through, though, 4 times a year is earnings. And so the example that Eric's showing up on the screen right now is that of Apple. And the upcoming earnings date that is actually tomorrow after the close, so February 1st after the close, and the potential of structuring a trade that could get through the Apple earnings event and take advantage of movement one way or the other. Now, as you can see on this structure, if you look down there in the bottom right corner, the actual structure of the trade is a March long put at the 185 strike price, and that cost for that put is $4.80. And the call option that's being used is a June short call, 195 strike, and you're bringing in $7.70 in credit. So with the stock currently trading,
185.53.
there it is, 185.53. I basically have protection to sell the stock right where I bought it, or pretty close to it, right? I'm buying it at 185.53. I've got the right to sell at 185 from now through the end of March. That's what that put option gives me the right to do. Or I shouldn't say the end of March, the 15th of March. The call option.
182.57 is the cost of this.
Yeah,
So-
182.57.
So
Total
actually, if the stock goes bankrupt and goes way down, I'll make $243.
Yep.
If it goes down, I will make money on this trade. If it goes up, I can make about $1,200 if it goes up. And the key is I could actually make more because I would close the put. I don't need the put if it goes higher. But this is a trade. It reminds me very much of, say, a straddle. So some people will go by a long straddle. If we look at what a long straddle looks like, it's a long call, a long call and a long put. So this is a very explosive trade, but your odds of making money on a straddle are less than 50%. They're usually overpriced, especially since earnings, but people want to do this explosive trade because they think, oh, it's going to make a big move in one direction or the other. I prefer to be I don't do a lot of straddles and straggles. I just don't have good luck with them. But this trade is something that I'm comfortable doing almost any time. And I keyed it up for you because over earnings, this is almost a no-brainer.
Well, and here's why it becomes a no-brainer. The straddle that you were pointing out before is a high probability of losing, and it happens sometimes really quickly right after the earnings event because of that concept of implied volatility crush. I don't want to go into the weeds about that for a lot in this broadcast, but essentially, once earnings happens, the price of options, the fluff deflates out of it. And so that's why straddles are so hard to win on, is because of that specific concept.
You said
the
fluff?
Trade.
Fluff?
I did say fluff.
Okay. Fluff.
Fluff.
Technical term, fluff. Some people know that as implied volatility, but I like fluff. We'll change it to fluff. I love fluff though, because I use foam sometimes as the analogy.
There you go. So the nice thing is about the collar trade that we're looking at right here is conceptually people may look at it and say, oh, well, look, the risk graph is the same, that orange line. Well, in theory, yes. And that if I look at the view statically, if this trades statically, yes, if I held this trade from now, which is January 31st, over the earnings event on February 1st, and if I held it clear until March 15th,
and the stock doesn't move,
and the stock doesn't move at all,
$272.
then yes, that is my theoretical risk. But the reality is Apple's going to move sometime between now and March 15th. It's going to start to move one way or the other. Sometimes it's really volatile right after earnings. Sometimes it just starts a trend. And so if I look at the green line there instead of the orange line, that's the one that actually will predict my profit level based on a potential move in the short term. That's its current versus the taking it to expiration. And as you can see, that line is above zero almost the entire time if I react relatively quickly to this. And that's the key to this trade. And again, I'm not going to go into the adjustments and all of the things.
You can't. There's too many to go through. You do need to know the adjustments, but Greg will tell you what I'm doing here.
You're making you're actually placing the trade?
Hell yeah.
All right. Maybe I'll do the same.
Oh, I didn't tell you. Last Wednesday, I closed all my Apple. So I don't own any Apple. All I have is a bearish Apple trade on. So I'm going to get filled on this while we're here. So this is a trade I'm very comfortable placing. Yeah, it's moving quite a bit though. So it's moving away from me. 64. I should get filled here. I'm just going to wait and be a little bit more patient, but I'm going to get filled on this trade before the end of the day. And this is a trade I'm comfortable, getting into, whether you already have a stock position. If you already have a stock position, maybe you manage it a little differently. What do I do afterwards? Stock can do three things. It can go up, it can go sideways, it can go down. How we manage that is, you know, you need to understand that. And there's a few other what ifs because time goes forward, volatility changes, stock price moves as well. And I am now filled. So there we go.
You know, to give you a little background on this trade, it's not something that is taught widely. Not a lot of people trade the collar trade like this. I, to be honest, kind of stumbled across this approach of how to trade the collar trade this way back in when the internet bubble was blowing up. In fact, it specifically was the company JDS Uniphase that taught me this strategy, and it's just something that we've adapted over the years at Options Animal of taking this approach that I can go through an uncertain event. The market could get really bearish right now because of what Fed Chair Powell just did potentially, and with this trade on, I don't have to worry about it. We could go through this earnings event, and Apple could say, "Yeah, we're shutting all of our plants in China, and we're going to move all of our manufacturing activity to India because of geopolitical risk, and therefore we're going to have this huge right." I'm making up a theoretical fake scenario, folks. This is not going to happen, but you could paint this horrible picture of what Apple may come out and say tomorrow at the earnings event, and if the stock got cut in half by 25 or got cut by 25% tomorrow, you're going to be fine. You're going to be just fine. The more likely thing is maybe they come out and miss earnings a little bit and warn on a soft consumer in parts of the globe. And so there's a short-term downward move on Apple that this trade protects you on, that then you can make a few little tweaks to that we teach you at Options Animal how to do, that put you in a position that when Apple does rebound, all of a sudden the profit levels get huge.
Yeah, so we modeled that things were moving and the prices were in flux, but this is what this trade looks like. And if we get any sort of movement in here, the trade can make money, and I'll definitely be making an adjustment after tomorrow. So understanding all of that takes some experience here to understand. But I own the equity. I love Apple. Like I said, I sold all my Apple last Wednesday, and so we'll see what Apple does. I'm not very confident that Apple's going to have a good earnings. I think it's going to go down, but I'm okay owning it in a collar trade because I have very, very limited risk here. And all I need to do is look at either rolling the puts or the calls or both, or closing them. So there's a lot of what depends on what happens. But I got a high degree of confidence that I'll turn this into a profit. And we'll be making changes not tomorrow, but on Friday morning. We'll be talking about this on Friday morning. That's a real trade, real money account. I just did it.
And I know Eric kind of jokingly threw out the idea of come to Las Vegas and see us in April, but
now you're going to withdraw that event?
I'm going
to take
gonna
away
say,
the invitation now?
Excuse me, I'm going to say no. Come, I'm seriously. It'd be great to see everyone in Las Vegas. Follow up with us. We'll give you details in future podcasts, future YouTube recordings here of when we finally lock the date in. But yeah, it'd be great to get together in Vegas.
So we're putting this content out there for you guys. I appreciate your thoughts and comments. Please share it. Share it with your friends. Say, hey, listen, this looks cool. What do you think? We really appreciate trying to grow the channel and get your feedback. Yeah, I think that takes us. I need to get working because I have to do a daily market update today, Greg.
You do. Thanks, Eric. Good to see you. Thanks, everybody.
All right, everybody, take care. Thank you. Take care.